Diversification?
But we must look
Is on here. State Street in as a highly successful fundamental.
The Triton geothermal agreement alone is projected to generate
at and dilution risks. We at Datavault AI's balance sheet, we see a going concern.
And February 2026. The sheer
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
A Datavault AI's closing bid price has fallen below the $1 threshold for 30 consecutive business days. This triggers a formal NASDAQ minimum bid price notice. Immediately detailing the trading volume dynamics surrounding this, the off-exchange short volume has reached 11,125,033 shares. That establishes an off-exchange short volume ratio of 58.45%. Furthermore, short interest remains at 25.91% of the float, with 3.56 days to cover, while 85 institutional owners are listed as long only.
Right. And we are looking at this data following Datavault AI's structural pivot from its legacy as WISA Technologies to a bifurcated Web 3.0 model, a model which now comprises distinct acoustic science and data science divisions.
Exactly. And I view Datavault AI's recent structural transformation as a highly successful fundamental turnaround. The position I hold is that the unprecedented surge in Tier 1 institutional accumulation coming from entities like Vanguard, State Street, and BlackRock, alongside a massive top-line revenue acceleration from $2.7 million in 2024 to an anticipated $200 million in 2026, objectively validates the company's core thesis. They are treating data as an asset class, and their edge node deployment strategy provides the infrastructure required to monetize that data.
Well, I approach this exact same set of data with deep skepticism. I view the organization's current state as highly precarious. When I analyze the severe structural and dilution risks, specifically the going concern explanatory paragraph in their audited financials, the NASDAQ delisting notice you just highlighted, massive insider selling totaling $32.4 million by executives, and the staggering authorization of up to 2.0 billion common shares, I argue these factors vastly overshadow the aggressive revenue projections. The complex tokenomics they've introduced seem to complicate rather than clarify their capitalization.
Let us begin by rigorously analyzing the nature of the institutional capital flows we observed between the fourth quarter of 2025 and February 2026. The sheer scale of the accumulation is what we need to focus on here. State Street increased its position by 51,505% to over 10 million shares. Vanguard increased its holdings by roughly 2,900%, bringing them to nearly 11.8 million shares. And Jane Street initiated a completely new position of almost 4.5 million shares.
But we have to look at how and why those shares were acquired.
Precisely. And that is why the off-exchange metrics I mentioned at the top are critical. The heavy off-exchange and dark pool volume facilitated by entities like XTX Topco, Citadel, and the Morgan Stanley pool represents smart money utilizing alternative trading systems. They do this specifically to solidify control of the float without telegraphing their moves and causing massive price slippage. They are quietly building conviction in the data science turnaround.
That is a well-constructed thesis regarding dark pool mechanics. But have you considered the underlying mandate of that institutional buying? I challenge the premise that this represents active conviction in Datavault AI's new business model. Much of this volume appears to be driven purely by passive index inclusion.
You believe it is strictly algorithmic?
The data strongly suggests it is. When you look at the Vanguard Extended Market Index Fund, or the State Street SPDR S&P Semiconductor ETF, these are automated allocations. As Datavault AI's market capitalization expanded toward the $500 million mark during its initial rally, it simply became eligible for broader institutional mandates. The fund managers at Vanguard are not analyzing the acoustic science patent portfolio and deciding to buy. The algorithm dictates that if the company meets a certain market cap, the ETF must purchase it to mirror the index. It is algorithmic obligation, not analytical conviction.
I see why you think that. And certainly, a portion of ETF buying is passive. But if it were purely passive index tracking, we would not see 85 institutional owners filing strictly as long only, while the short interest simultaneously remains elevated at nearly 26% of the float. The off-exchange short volume ratio, sitting at almost 59%, tells us proprietary trading desks are taking the short side, assuming the turnaround will fail, while major asset managers are holding the long side. Jane Street, for example, is a highly sophisticated liquidity provider, actively managing a new multi-million share position.
I am not convinced by that line of reasoning, because we cannot look at institutional positioning in a vacuum. We have to contrast it with the aggressive distribution by the individuals who actually know the internal mechanics best, the insiders. In the 90 days leading up to February 2026, insiders offloaded over 31 million shares. That is approximately $32.4 million in value exiting the company.
Insider selling can happen for a variety of reasons. Tax obligations, diversification.
But we must look at the concentration of the selling. This was driven heavily by CEO Nathaniel T. Bradley and Chief Accounting Officer Stanley Mugwa. When the executive suite is actively liquidating tens of millions of dollars in equity, while the retail shareholder base is facing a NASDAQ delisting notice, we have to pause. We have to question whether these insiders are merely providing dark pool liquidity, as you suggest, or if they are actively exiting their positions before the retail base is diluted.
That is a fair observation regarding the optics of the selling, though I would frame the mechanics differently. When active institutions like Vanguard and State Street require millions of shares to fill their mandates, that immense liquidity has to come from somewhere. The public float was tight.
You are suggesting the CEO sold simply as a philanthropic gesture to provide liquidity to Vanguard?
Not philanthropic, but structural. The reduction of overall insider ownership down to 7.7% is a coordinated redistribution to allow Tier 1 capital to enter the stock. And we must look at what is fundamentally driving that capital influx: the unprecedented revenue acceleration. We are not talking about marginal improvements here. Datavault AI recorded $2.7 million in top-line revenue for 2024. For 2025, they revised their midpoint guidance to $39 million. That represents a 1,344% year-over-year growth rate.
I will concede that a 1,344% growth rate is mathematically impressive, but we must scrutinize the composition of that revenue. That jump to $39 million was driven almost entirely by $49 million in tech licensing agreements signed in a single quarter, the fourth quarter of 2025.
Exactly. And those Q4 agreements form the fundamental bridge to their $200 million revenue target for 2026. We're looking at concrete commercial drivers. The Triton geothermal agreement alone is projected to generate up to $8 million. The MTB mining deal is structured for $7 million up front.
Assuming those mining and geothermal entities actually execute.
The corporate partnership suggests they will. Furthermore, we must factor in Silex Holding Company. Silex has taken a massive 37.27% equity stake in Datavault AI, which is over 213.7 million shares. Silex also announced a $150 million strategic investment specifically to build a supercomputer optimized for Datavault AI's infrastructure. It is backed by immense strategic capital targeting the $2.0 trillion pharmaceutical data market.
I acknowledge the aggression of the revenue targets and the scale of the Silex partnership. However, I have to pivot our focus to the existential operational risks required to actually realize those targets. To achieve this, Datavault AI must execute a highly capital-intensive rollout of edge node infrastructure across 100 U.S. cities.
Which is precisely what the Silex investment helps facilitate. Building near-edge compute power is essential to support their AI-driven valuation workflows.
It is essential, yes, but it is also incredibly expensive. Data centers, cooling systems, real estate, and hardware for a 100-city rollout require a massive continuous cash burn. And when we look at Datavault AI's balance sheet, we see a going concern explanatory paragraph from their auditors. This indicates an urgent need for near-term financing.
Capital requirements are standard for any infrastructure scaling phase.
Standard, perhaps, but the specific mechanisms they have in place to raise that capital are highly dilutive. They maintain an active Form S-3 shelf registration for 5 million shares. More alarmingly, the organization has authorized up to 2.0 billion common shares. When a company with a going concern warning authorizes 2 billion shares while its stock is trading under $1, it sends a very clear signal. Heavy dilution is likely imminent. I argue the equity base will likely be severely diluted long before that $200 million 2026 revenue target can ever be realized.
The authorization of 2 billion shares provides the company with traditional equity optionality, but we cannot analyze Datavault AI purely through the lens of legacy balance sheet mechanics. They are pioneering non-dilutive ways to raise capital through their Web 3.0 tokenomics.
This is where the structural narrative completely loses me.
Let us examine the mechanics of their corporate actions carefully, because they are specifically designed to drive shareholder engagement while onboarding users to their proprietary Datavault wallet system. For instance, they introduced the Josh Gibson coin dividend, issued on a one-to-one basis per share of common stock. They are actively partnering with Sports Illustrated and the NFL alumni to pioneer name, image, and licensing.
I just do not buy that these maneuvers are fundamentally sound capital formation strategies. We are discussing a company that supposedly aims to secure and process data for a $2.0 trillion pharmaceutical market, and they are attempting to fix their capitalization by issuing a Josh Gibson historical baseball token?
You have to look at how these tokens function within the broader ecosystem. Let me outline the structure of the warrants. They issued the Dream Bowl Meme Coin 2 warrants at a strike price of $5.00. If those warrants are fully exercised by the shareholders, they would generate $48.3 million in much-needed capital for the company.
Assuming the stock ever gets anywhere near the $5 strike price.
Correct. But the unique structural condition of this specific warrant is that shareholders must retain the associated meme coin in a verified digital wallet in order to exercise the warrant. It ensures that investors are forced to become active participants in the Web 3.0 ecosystem Datavault AI is building.
Let me tell you why I view these specific corporate actions not as innovation, but as immense administrative friction and a glaring regulatory red flag. Distributing Dream Bowl meme coins as a token of appreciation to Silex shareholders and requiring the retention of a meme coin in a verified digital wallet just to exercise a warrant introduces unprecedented complexity.
It is a paradigm shift in how corporate dividends are distributed.
It is a paradigm shift that begs a very serious question. Are these maneuvers genuinely establishing a proof of concept for real-world asset tokenization, or are they speculative gimmicks designed to distract from the August 24, 2026 deadline to regain NASDAQ compliance? You cannot pitch institutional investors on enterprise-grade edge nodes for pharmaceutical data valuation while simultaneously managing your corporate treasury with meme coins.
I disagree that it is a distraction. The acoustic science legacy, combined with the data science division, creates a unique proprietary infrastructure. The token distributions are simply the first live stress-tested iterations of this data valuation protocol operating at scale.
But we absolutely cannot ignore the strict regulatory timeline they are operating under. They have an August 24, 2026 deadline to regain NASDAQ compliance. Distributing meme coins does not inherently fix the underlying capitalization structure that drove the stock below $1 for 30 days. The executive focus should be intensely fixed on traditional capital management, not engineering complex token dividends that confuse the retail base.
To synthesize my perspective on the material we have examined today, Datavault AI's transition from a hardware legacy into a high-margin data science software provider is supported by empirical data. The 1,344% year-over-year revenue jump for 2025, moving toward a $200 million target in 2026, provides a fundamental underpinning for the elite institutional accumulation we are tracking. Backed by $150 million in dedicated Silex computing resources, the company represents a pioneering leap into the tokenized economy. By utilizing an edge node infrastructure, they are positioning themselves to definitively treat data as a secure, monetizable asset class.
And my position remains that despite the intriguing data as an asset class narrative and the massive revenue percentage jumps, the structural reality of the equity is flashing severe warning signs. The stock is currently trading under the $1 threshold,
we have observed $32.4 million in aggressive insider selling from the executive suite. The active going concern status, combined with the looming threat of massive dilution via the 2.0 billion authorized common shares, paints a picture of extreme structural risk. The tokenomics, in my view, add unnecessary administrative risk when the company desperately needs traditional financial stability.
The polarization we have debated here today is perfectly mirrored in the broader market consensus regarding the stock. We have analysts at Maxim Group issuing a $4 price target with a definitive buy rating, basing their model entirely on the forward revenue multipliers and the Silex partnership.
Which is directly contrasted by Weiss Ratings, which maintains a strict sell stance due to the precise capitalization and dilution risks we just outlined.
The true objective test of Datavault AI's bifurcated model will unfold over the coming months. We will see if they can attempt to convert their $49 million in fourth quarter 2025 agreements into reported revenue while navigating the intense pressure of their NASDAQ grace period.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!